Welcome back. We recently see the release of the S&P Case-Shiller Home Price Index. Home prices in June were up 18% year over year, now registering a third consecutive monthly decline. How does that make sense? Prices were up 18% year over year, third consecutive monthly decline. Well, let's take a look at the data. First off, we can see here the home price index, top left-hand corner, a steady blue line to the upside. Today's number was not so great, lackluster, but still looks like it's going higher. Well, take a look at the actual numbers. We have the home price index released 306.18. That's the highest high we've seen over the past 10 periods. Prior to that, we have a release of 305.17, 301.409, etc. So, looks like it's good news. However, not so fast. We actually see the home price index is up by the smallest amount, 0.33%, compared to the prior number of 1.25%. Each one of these numbers is a monthly rate of change, meaning we're up only 0.33% from the prior month's number. But when we talk about economic numbers, especially those, I believe, that are more sensitive to seasonal factors like housing, for example. A lot of people tend to buy homes in the summertime. Then we have to take into consideration the numbers as they're recorded year over year, meaning compare this June to last June, this May to last May. You know, the holiday shopping season, we see a lot of a huge increase in retail sales. You know, it would not be fair to compare November shopping to February shopping. So we compare November to last November. Now, for example, this is a lot of fun here. We take a look at our home price index. This is year over year. So what we're doing is we're comparing this June to last June. And we see this is actually the smallest rate of increase, actually in quite a while, at least going back about a year or so. Moreover than that, May to May, year over year, and April was higher this year than it was last year, but May was a disappointment as well as June. So we can see a steady rate of decline. Taking a look at the U.S. bond yields, I want to take a look at this really quickly. I know we talk about it almost every day, but we're really in a very unusual situation here. On the left-hand side, we see the 30-year bond currently pays 3.27%. The 20-year bond pays at 3.53%. So we see that the 30-year bond yield is lower than the 20-year. That's called an inverted bond yield. Under normal economic conditions, we tend to see longer maturity bonds pay a higher percentage. Also, we see a massive inversion in the bond yields where the 10 is only paying a 3.15. The 7-year pays 3.25, the 5-year 3.30. I mean, we're seeing a 3.5% yield on the 1-year bond and only a 3.15 on the 10-year bond. Again, what this means is that investors are not willing to take the extra risk by buying the longer-term maturities. They'd rather move their money into the shorter-term maturities. The top right-hand side, we have the red line. That's the total bond yields. Those are all the different maturities added up. So the 30-year percentage plus the 20-year, etc. And we see the interest rates overall are going up. Why? Because the Federal Reserve told us to get prepared for more interest rate hikes. Now the blue line is, of course, the S&P 500, which has been very weak lately. The chart on the left-hand side, the red line is the same total bond yield, but the green line represents the spreads. Normally, under normal, healthy economic conditions, we see increasing spreads. Traders are willing to pay even more for the 30 than the 20, even more for the 10 than the 5. But that's the opposite now. What we're seeing is that the spreads, the relationships between each pair of different maturity bonds is contracting. And it looks very similar to the S&P 500. Actually, I'll tell you how similar it looks. Take a look at the correlations. The spread between the 30 and the 20-year bond has a 94% correlation, almost a perfect correlation to the S&P 500. The 2010 spread has a 95% correlation. So if we take a look at this in greater detail, the black line represents the S&P 500, steady trend to the downside this week. Take a look at the purple line. That represents the 2010 spread. The difference in interest rates between the 20 and the 10-year bond. Compare that also, S&P 500, to the 30-20 spread. Orange line is the difference between the 30-year bonds, 20-year bonds. It's going down. Now we know from the prior chart there's an inversion, which means the 30-year bond pays 327, the 20-year pays 353, but that negative relationship is actually increasing. It's getting worse, so to speak, and that completely coincides with our decline in the S&P 500. Going back to the housing numbers, the Case-Shiller Home Price Index released this morning, that is one of the numbers that we take into consideration when we look at the blue line, which is the housing index. That so far is still going up, at least, to some extent. The yellow line is the S&P 500. The only real decline we've seen so far is inflation, the red line. So, and these are our own custom little, composite indices of either inflation, which is reflected by the red line again, the housing numbers, which are blue, and the growth index, which is green. The growth index is made up of a combination of retail sales, industrial production, capacity utilization, non-farm payrolls coming out soon, durable goods we had last week, that wasn't such a hot number, business inventories, manufacturing as well. So although we look at the micro numbers, like the year-over-year housing numbers, that doesn't look so good. But overall, the big picture, growth is still quite strong if you take out GDP. Inflation is still strong if you take out the last number or so. So point being is that, overall, I would say that it looks like there's trouble on the horizon. But if you take a look at the big picture, it's hard to see that trouble. If you start to look in on the minute differences, and for example, we go back to the home price index. Look, overall has a steady trend to the upside. Not bad. If you take a look at this number, highest number we've seen in quite a while. But then you take a look at actually, to focus in a little bit more, 0.33% increase. That's the smallest increase we've seen in a while. Why didn't it go up more? And year over year, no, not so hot. I mean, it is an 18% increase over the past year. But then again, we've seen a lot of inflation this year. We would expect to see home prices go up only because inflation, pushes home prices up. But it's the smallest rate of increase. So we haven't reversed yet on these numbers, but the fact of the matter is we're slowing down. What else do we have here? So, also, this is very interesting. So the yellow or orange bar chart or area chart, here's the S&P 500. We see a long move to the downside in June, sharp move higher, not sharp, but a steady trend higher. And now over the past week or so, we've seen a real steady decline to the downside in the S&P 500. Now, the blue line represents the combination of long-term bond yields, meaning that the 30 plus a 20 plus a 10. The red line represents the medium-term bond yield, 7, 5, 3 maturities, 7-year, 5-year, 3 maturities. The green line represents the short-term yield. Consider it like this. When the market's going up, when the stock market's going up, for example, we see traders move out of the green line. They sell the short-term bonds because they say, hey, why not? Let's take some risks. Stocks are going up. The bond market's got to offer us higher yields. That should go up also. The economy looks strong. Take a look what happened. At the end of the downturn in June, the blue line crossed above the red line. The long-term bonds started to offer, relatively speaking, more than the medium-term bonds. That was a pretty bullish sign. If you had bought stocks around that level, well, that was a 3,800 S&P, and we went up to around 42, 4,300. However, when we start to see that the green line more recently, really in the month of August, starts to increase, take a look at the blue line trending lower, approaching once again the medium-term line. That's bearish. Again, in a strong, healthy economic condition, we want to see the blue on top, then the red, then this green line. But we start to see the green lines pulling away. Think of the green line as some sort of insurance. If things don't look good, we're going to buy more short-term bonds. We're going to sell the long-term bonds definitely. This right here shows us the inverted bond yield a little bit in a different manner, so to speak. So all very interesting. We can take a quick correlation, take a look at the correlation between the existing home sales, which was released today, and then of course we have non-farm payrolls, which we're going to get at the end of the week, I believe, and that is going to be 300,000, I believe, is the estimate. But we'll have to see, because so far the employment situation, it hasn't been great, but it hasn't been awful either. The non-farm payrolls is a red line. If we start to see that decline the way the existing home sales has, well, maybe that's another precursor of more to come. But overall, we can see that we're starting to see a little bit of a weakening in what was once very strong trends. So we'll definitely keep an eye out for more development on that note. We hope this has been helpful. We'll see you back real soon.